You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Yeah, tremendous deal flow. My hair's blowing in the wind of the deals being thrown at me right now. It's absolutely amazing.
Thank you for tuning in to another episode of Mining Stock Education. I'm your host, Bill Powers. I'm speaking today with the editor of the Gold Newsletter, goldnewsletter.com, Brian London. He's also the host of the New Orleans Investment Conference. Brian has a multi-decade history of commentating in the gold and junior gold stock sector. With that being said, Brian, welcome back onto the program. Thanks for joining me for an update. Let's start with the gold price. So we've been looking at the gold price. In the last 9 weeks or so, it's been trading in a range between 1680 and 1755. It looks like it's consolidating and forming a base for a future move. What's your commentary here?
Yeah, I think that's exactly it, forming a base for a future move. And, as we speak, you and I'm busily writing our July issue of Gold Newsletter. And in some of our other recent publications, our free Golden Opportunities service, for example, I've been telling people that, go back a few weeks, I've been telling people we're going to have a soft patch in the metals prices in gold and silver for a few weeks. And then, we'd probably get back on track as the news from the pandemic and the economy started coming back in again. And it looks frankly like that's what's happening right now. The gold's been in a consolidation pattern, kind of a flag pattern technically, since mid-April or so. From mid-March to mid-April, it just made a furious run higher. In the last couple of months, it's been consolidating those gains, digesting them, et cetera. It kind of looks like that's ending right now. I mean, not just the fact that as we talk, gold's been up for 2 sessions fairly strongly, but also you look at the Bollinger Bands from a technical standpoint, and they're pinching, compressing, indicating a breakout one way or another. And in a gold bull market environment like we're in for gold, that's usually a breakout to the upside. So that looks like we're either in a breakout to the upside right now, or it's really imminent. I was going to say seasonality and the fundamentals, I think, are also arguing for a breakout now or very soon.
If it breaks down, do you have a downside target where you see key support?
Well, I prefer not to think about that, but yeah, I think that 1700, in this consolidation pattern, 1700 wasn't really a floor, but we didn't get much below that. We kind of oscillated around that level for a while. I don't think we would get much lower than 1650. There's just so much fundamental support for gold right now with all of this monetary stimulus that I think any dip into the mid 1600s is going to bring in a lot of buying from Asia and in other areas that are more, bargain hunting oriented.
Recently, I've listened to commentators on either side of an idea. One of the side says that the U.S. dollar will continue to rise with gold. The other camp says that we'll see a steady decline in the U.S. dollar as gold climbs. What's your commentary here?
That gold climbs in both scenarios. I look at that and I enjoy the arguments on financial Twitter between the two camps and the like. But I think both arguments have merit to them. I could see either scenario playing out. And I think when you try to fine tune these things, well, it's natural if you're a trader, but if you're an investor, you just look at the future and you look at the big forks in the road that can go either way. Economic recovery, well, that'll be inflationary. That'll help gold because of all this monetary liquidity. You have economic slowdown. Well, that's going to prompt the Fed to boost their efforts even more so, and fiscal stimulus as well. All of the big potential scenarios going forward are bullish for gold. Now, that doesn't mean we're going to have an easy climb up by any means. We're not going to have that. We're going to have setbacks. The purpose of a bull market is to get you to check your premises and try to shake you out. But long term, there's a compelling, virtually irrefutable argument for higher gold prices, no matter what happens to the dollar, no matter what happens to all the other asset classes. both of those big scenarios I was talking about are actually bullish for equities in this scenario. And in any environment where everything is being driven by central bank liquidity and fiscal stimulus efforts, all correlations go to one. Everything seems to benefit. But if you're looking down the road for, an eventual devaluation of currencies, of fiat currencies, which is seemingly inevitable, then you want to own gold as insurance. If you're looking for more torque and you're looking for investments, well, it's hard to beat anything like the junior mining stocks in an environment where gold and silver prices are rising so strongly.
If in 18 months from now, as some commentators like Martin Armstrong have said, we could see 40,000 Dow instead of 25,000 Dow, could gold still be at 2,500 at that point? Would that be a good expectation?
Yeah. There are a lot of ratios there, and the Dow to gold ratio, I think, is showing that the gold is still very undervalued in relation to stocks. But again, in this kind of environment where everything's being driven by such liquidity, I don't know that those ratios have a lot of value anymore. But yeah, I think that this environment is bullish for all financial assets. It's certainly bullish for the precious metals, at least in the near term. I mean, you can still have some significant downturns in the equities market because it's so overvalued by every standard measure right now. But by the same token, the metals are still undervalued. So, there's obviously I have a preference for the metals and the derivative investments like the mining stocks.
Brian, can you talk about what type of deal flow you're seeing come across your desk, what you're being offered, and what does this indicate about where we are in the cycle?
Yeah, tremendous deal flow. My hair's blowing in the wind of the deals being thrown out right now. It's absolutely amazing. And obviously, this is a kind of environment where junior mining companies are rushing to market to raise money, while the getting's good, as it were. That protects probably, if good financing now protects salaries for the next couple of years. And it's smart, and they can get some work done. And a lot of work is getting done right now. So we're getting good news flow. It is, you have to worry about it getting overheated. I'm thinking twice about financings when, a month and a half or so ago, I was grabbing everything that was being thrown at me. They're getting more expensive. I'm trying to get more selective on them. And, after decades in this market, you start to worry when everybody's getting so excited, and you start to think about the other problems, the other issues, which are good ones to have for a change after many years. But the other issues of cash management, when to take profits off the table, how to deploy, from big winners into early stage companies. And, we're starting to see that now. We're starting to see money refunneled into the market, and that's lifting everything. But investors just need to be careful in times like this. And the really, really easy money has been made. I think there's lots more to be made, but we have to start being a bit more selective, I think.
Even on the early stage exploration companies, because some private placements that have been proposed to me, as I've been observing a lot of these even earlier stage exploration plays, after the financing, a lot of them will triple even before they're anywhere near, bringing forth the drill results. And if it comes with warrants, your potential risk is a lot lower because you could potentially get back your initial capital and more with the warrants even before the drill results come out.
It depends on the deal, obviously. A couple of months ago or a few months ago or even further back, these early stage exploration companies were ones that had really great prospects. But, money wasn't out there. So these new financings were at very low levels. Now, companies that have that same quality of assets are financing at very much higher levels. So the early stage juniors don't have typically the kinds of projects that a company at the same stage would have been a few months ago. And you have to start looking at things like if you get into financing now, that's the hot financing, and everybody's getting into it because everybody's speculating right now and trying to get the triples and the quadruples. Well, everybody's going to, the starting gate for the liquidity of those placements is going to happen for everybody just about at the same time. So you have to worry about what's going to happen 4 months from now. And and how to mitigate that risk. They can fly pretty high in the meantime, but when all that stock comes into the market and some of these speculators and traders start to clip their holdings for the warrants exposure, you're typically going to have a downturn unless there's good news flow at that time. So one of the things you can do is take perhaps a third or a half of what you were going to put into financing and buy that stock in the open market. And then as it's flying high in the meantime, before that stock comes free, then you can sell and mitigate the risk a bit, or take advantage of those prices. So there are some tricks of the trade, as it were, that you can play with there. But that's another thing you have to worry about is a lot of these widely held placements. When they come free, everybody's going to be, or not everybody, but a lot of the people are going to be rushing for the exit doors at the same time.
We'll be right back after this word from our sponsor. Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com. What percentage of your new purchases, additions to your portfolio, are being bought in the open market versus private placements?
Well, I'm a bit limited here than most people. I don't front run my newsletter. I'm kind of old school in that. So if I like a company enough to buy it in the open market, then I should be recommending it in the newsletter. So I don't until I recommend it in the standard issue of Gold Newsletter. Not the alert service is a different thing. But still, the alert usually comes out before the newsletter. So I have to wait until after the regular issue of the newsletter comes out. And everybody's had a chance for a few days to buy the stock before I can buy it in the open market. I think I'm maybe the last newsletter out there that adheres to that policy. Mm-hmm. But that said, and as a result of that, most of my investing occurs through private placements, which I can buy or allow myself to buy before stock is recommended. In most cases, the companies I invest in on private placements are never recommended in Gold Newsletter, just because I speculate in some things I wouldn't recommend to other people. But the idea being that in a placement, I'm not front running anybody because that doesn't affect the market price of the stock. Not that my buying would in any effect, but still, again, I'm kind of old school in that respect.
Feedback from subs. What have your subscribers? What are you feeling in terms of sentiment and specifics that your subscribers are asking you?
Yeah, it's good. It's good. It's not absolutely overheated. We're getting people who are very grateful that they're getting doubles and triples, et cetera, at this point in time. We kind of went out in early March, and if not an absolute buy recommendation, told people that you can do what you want to do, but I'm buying hand over fist, which I was. Because it was really a scary time, but a lot of people waited until, well into April to start recommending again. But I had seen this movie before, post 2008 liquidity crisis. It was pretty obvious to me what was going on. So we started buying and recommending some stocks at those levels. And so a lot of our readers are very grateful for that and made a lot of money early on. But, I go back to like the early 90s bull market when I had people calling me up saying they were buying on margin with credit card debt. And I was just aghast at telling them, sell, get out, don't do that. But we haven't reached those levels of frenzy yet. And I do think we're at least a couple of years from those levels. That said, it's going to be ebbs and flows along the way. Right now, we're building up to, another high tide, as it were, as far as the speculation in the juniors. For the metals themselves, I think we're building up to another run higher as I indicated, at some point over the next week, 2 weeks, something like that, especially as we get into July and some of these stimulus efforts are renewed.
Many resource conferences have gone virtual, even ones that are planned out even into the fall. Yours occurs in the fall, so is the New Orleans conference virtual this year, or are you going to do it in person?
Well, stay tuned for a big announcement shortly. We're working through our options right now, Bill. We're working with the hotel. We're working with virtual platforms. We will be virtual, I think, obviously, to some extent. Everybody has to at this point. But we're still bouncing around the ideas and the concepts. One thing I can assure people of at this point, and they can rest easy knowing that if we do go virtual, we are going to have a lot of the unique flair and ambiance that only the New Orleans conference can deliver, and especially value. We're very big on just, I'm of the people that I market to for our conference. We are one and the same. We think the same way. We like the same things. And I have a good handle, I think, on what is real value for that audience, which I think is an audience you share as well. So we're focused on delivering more value through whatever means and platforms than anybody else out there, in finding ways to continue to distinguish and ourselves from everyone else out there. And that's not to say that there aren't an awful lot of great conferences and events, virtual or live, out there that we also or go to, attend, et cetera, because they do deliver good value. But we've always been a bit different than everybody else. And that primary difference, I think, is value, as well as a sense of belonging and camaraderie that you just don't get everywhere else. So we're going to make that translate as best we can this year. Going forward, I think every event going forward is going to have some virtual component. I think it just has to. Yeah,
that was going to be my follow-up questions. Do you think this is going to be par for the course for the resource investment conference industry?
Yeah, I do. We get so ingrained in our thinking and ways of doing business, and sometimes we have to be dragged kicking and screaming into the modern age because everything we've been doing for years has worked well. But now, life is a way of slapping you upside the head with a 2x4 every now and then and forcing you to face realities. And what I tell people and in various other groups and that I'm involved in that had to go virtual, that you need to look at these things not as tragedies or big negatives, but as opportunities to figure out a new way of doing things. And I think what you're going to see is at these events that you're going to have a live event and everything that only a live event can deliver in terms of, just the random encounters and walking up, meeting people and interacting like that. But you're also going to see these events able to dramatically extend their reach into that the cyber world, as it were, and have people from around the world participate and get value. And that extends to both the attendees who can hear speakers that may not be inclined or able to travel to the live event, but also for the exhibiting companies that now have a way to reach a lot more people, in a different way, but still be able to get their story out to a lot more people. So it's going to be interesting, but I look at it as a real opportunity for the New Orleans conference.
The one thing I would say that for sure cannot be replaced is the networking that goes on, because when I started going to conferences 4 or 5 years ago, whatever it's been, it's the business cards you get, the fellow investors you meet, to where you can bounce ideas off, screen possible investments with, and you can't really virtually create that online.
That's right. And, in a bull market, some of the best opportunities are found at the hotel bar, and that's difficult to do in a virtual world. So yeah, it's going to be interesting, and it will be interesting when everybody gets back to live events and how that's handled. But I I don't like to travel that much, but I do miss the networking at some of these live events.
As we bring this conversation to a close, I'd like to get your insights and commentary on the rise of what they've termed the Robinhood traders, where the younger investors, many millennials, are opening the free investing app Robinhood, using margin and trading. It seems to have created a lot of volatility in the markets. What's the end game here, or the end result of this current trend we're seeing?
Well, the same as it's always been. We've been around the block a few times. We've seen it every time. It harkens back to what I was saying in the early 90s in the gold stock market when I had subscribers calling me saying they were buying on margin using credit card debt. Just crazy stuff. There's not a lot of difference. The methodology may differ, but the psychosis is exactly the same. And it's just become more efficient. So everything is getting sped up. If there is a difference, the famous last words in investing are "this time is different," and it really isn't as far as the psychology goes. But if anything is different now, it's just that everything's been sped up. Even from 2008, post 2008, we saw 5 years or so tremendous liquidity by the Federal Reserve, and now we're seeing that in same amount of liquidity generation in 5 days, maybe 5 weeks, but literally, the Fed went to full on unlimited QE in the matter of just a few days after they realized the potential scope of the crisis. So everything is sped up right now. Everything's at warp speed. So that kind of speculation that we're seeing in Robinhood will end in tears. It's just going to be quicker, I think, than what we've seen in the past.
And do you think it'll end in more regulation as well?
It always seems to. They never give up power, and they try to protect people from themselves. When in fact, if they removed regulation and allowed people to get their fingers burnt early and often, then the markets would self-regulate to a much better extent. But yeah, it will. It will. It's going to make investing probably harder than easier eventually.
Brian's website is goldnewsletter.com. Go check that out for Brian's subscription service covering the junior gold stocks. There's also a link at the top right of that website, and you can find more information about the New Orleans conference that Brian spoke about on today's show. As always, Brian, I appreciate your insights, and thanks for joining me today.
Thank you so much for the opportunity, Bill. Great talking with you.